For those of you who have not attended our programs before, perhaps you're not familiar with everyone in attendance. Lorne Saltman had just introduced himself, and of course, Lorne is a partner with Gardiner Robertson, Special Counsel to Quantum Business Law. John McLeod, International Chairman for Eticas International. Michael Miller, Head of Litigation for the Quantum Business Law. And myself, for those of you that don't know me, I'm a partner in Quantum Business Law, and I basically work in assisting business owners to position themselves to derive a number of tax benefits, some of which are not very common. We also work on achieving asset protection in a litigious world. So having said that, I'd like to talk to you a little bit about our agenda today and what you're going to hear about. In the education work we do, whether it be at the Ontario Bar Association, CPA groups and so on, associations, CCA, wherever we've lectured in the past, we often speak to groups of lawyers separately or groups of accountants on their own. And at a recent event, I asked a group of lawyers, what are they doing to protect their clients' assets? And one of the answers that I got is we're segregating assets and depending upon limited liability. In other words, you may have real property or real estate that's in one corporation, and you have an active business. We have clients and various different risks that may not be the same. And in order to protect assets, we can put assets in different compartments or different corporations in order to achieve asset protection. And depending upon the concept of limited liability, meaning that the liability is limited to that corporation and not to the shareholders, or so on. And sometimes we have shareholders that are other companies, like a holding company. To that end, I can recall a meeting that the experts on our panel today had at a very prominent accounting firm. And one of the questions was asked, well, how do you protect assets of a client? Oh, well, that's simple. We have a holding company that holds a share of the operating company, and we push dividends up tax-free. And we keep the dividends inside of the holding company. And that's how we do it, right? And of course, that causes a huge question. So if you have an Opco, Holdco structure, holding company, holding the shares of an operating company, and you have assets sitting in the holding company, are your assets genuinely safe? To that end, I'd like to call on Michael Miller. Michael, perhaps you could comment on whether or not the assets are genuinely safe in either of the two scenarios, compartmentalizing assets inside of a corporation and depending on limited liability, or pushing dividends up to a holding company.
Well, if this was a movie, we could have flashed on the screen, warning, this may be scary. So for the next hour, you're going to hear some things that you may know, you may not know. You're going to think you're safe when we're going to point out some ways in which you may not be safe in protecting your assets. Believing that you've got limited liability, you may not have limited liability. And when you get into bed at night, you're going to hear things that you could be thinking about, and if not, you should be thinking about. So we're going to do the basics today, and you're going to hear numerous different things. As an example, we talk about we're safe because we have a corporation and we're protected by that corporation, but in fact, it is not uncommon to have that, what they call the corporate veil, pierced. You may think that you've protected yourself by not showing up as being in control of the company so that you've protected yourself. But in fact, if you're in de facto control, that also could bring you into being liable on things. If you're the controlling mind of a corporation, you make the decisions, the corporation carries it out on your instructions and the way you want it done. That also could put you and your assets at risk. So these are just many of the things that we're going to talk about today. And then, of course, like all good movies, towards the end, we're going to tell you how you can have a happy ending.
Thank you, Michael. I'm going to suggest to the audience that our group does not like aggressive tax planning. I'm going to suggest that structures that involve continuance of corporations into British Virgin Islands or, say Delaware, or where there's the only benefit, the only goal is tax avoidance, is an unsavory move for a prudent business owner who is attempting to conduct his affairs in a way that, as Michael said, all can sleep at night. To that end, I'd also suggest to you that we also don't care for structures that take advantage of lower tax rates in other jurisdictions. And we've all read about them. There's case law such as Garin. Those lawyers in attendance and accountants will likely recognize that case. And other cases, other situations like Panama Papers, none of those things are desirable in our view. Those are exploitive. Those are structures that are a time bomb waiting to explode. But to that end, we do like the use of trusts. And maybe, John, you could give our audience some idea of what they're going to hear about the use of trusts in protecting assets.
Sure, thanks, Todd. I've been in the trust business, if you will, or in the financial services sector for over 25 years. And so I'm very conscious of asset protection and liabilities. And we've all learned that creditors come from a lot of places. There are business creditors, there are family creditors, there's revenue authorities as creditors, there's regulators as creditors. And so what we're going to talk about today is developing a conservative ownership strategy that will provide asset protection at the best attainable tax rate without being aggressive and without subjecting clients to undue risk.
Yeah. And by the way, I thought I just mentioned to our audience that John McLeod is an expert in this area of trust, and he's known internationally. He's used to be the head of fiduciary division for the Royal Bank, and of course is an international chairman of a group of companies that are situated from Geneva, Switzerland to Singapore to Barbados and elsewhere. And so I just wanted to make that proper introduction, John, and thank you for your comment. Lorne, perhaps I can call on you just to kind of give the audience some glimmer of what they're going to hear as far as tangible benefits and what it might translate into as we unfold our program.
Sure, Todd. What we're going to try to do is help people in the audience understand some less well-known risks associated with classic arrangements, such as you mentioned earlier, where you've got a Holdco, Opco structure. Paying a dividend up from Opco to Holdco should be good asset protection. It's not. There are some hidden landmines that we're going to touch on. And we're going to talk about positioning your company for a liquidity event and being able to take advantage of the lifetime capital gains exemption. But what about surplus assets within one or more of the corporate structures? How do we purify and position the company for that future event to obtain the maximum tax advantages? And we're also going to be talking about how to fold all of these things into an ideal ownership arrangement that protects the entrepreneur during his or her lifetime, provides for succession where appropriate to the next generation who are active in the business, but even those who are not active, but whom, let's say, the parents want to protect and provide for. And that's where the trust structure that John began to talk about a little bit fits in as the overall umbrella that gives us the maximum asset protection, flexibility for succession and benefit planning, and the lowest compliant tax rate. We want to be able to combine all of that into the best structure for clients and customize the solution to the client's needs.
Oh, thank you, Lorne. That's great. I'm going to also just add to that to say that, the theme of our program today might be one that is leaving you wondering, what on earth could we be talking about? How corporate assets can become liabilities. Well, we've talked a little bit about, the fact that we may be lulled into a false sense of security, and we may be in a problematic situation without even knowing it. And one of the things that we're going to be focusing on is how those assets that you have inside of your corporations could be a huge concern. And then more importantly, how are we going to resolve it for you? So we will drill down a little bit further as we go, but we'd like to set the stage and provide a little bit of background for you as far as what all this means. And before we go further, I would like to just take a minute to provide a bit of a glossary of terms, if you will. And obviously you accountants and lawyers in attendance will have more familiarity with some of the issues than the business owners in general, but we're here to make sure that everyone thoroughly understands everything that's being said. Now, as the backdrop for our program today, there's a couple of things that it's very important to understand because there's a lot of confusion. I'm sure everyone in attendance is familiar with the lifetime capital gains exemptions that are available for qualified small business corporations, active businesses. And of course, it works out to this $883,000 a year for each shareholder. There can be multiple shareholders, by the way. And one of the things that we want to make crystal clear at the beginning is that holdcos that hold opcos do not have a capital gains exemptions. Only the individuals have a capital gains exemption. And oftentimes those things are overlooked where individuals are paying up these dividends into the holding company. And what many business owners are surprised is to learn that the presence of cash inside of a holding company could cause the loss of a capital gains exemption. Not only that, but it's a target for some kinds of creditors. So just maybe what I'll do is I'll call on Lorne Saltman to briefly describe the three-part eligibility for the capital gains exemption. But before I do that, I want to make one very clear distinction. There's a misconception that we see in every city across Canada when we're dealing with accountants and lawyers, and that is that sometimes there's a misconceived notion that the eligibility for a small business deduction is the same as for qualified small business corporation shares. In other words, you may not have a small business deduction because your taxable capital might be too high. Your company's grown too fast, too big. Small business deduction's gone. That doesn't mean that your capital gains exemption's gone. I had this conversation not very long ago with a law firm and accounting firm who basically were doing all the planning on the basis that there was no qualified small business corporation shares. In other words, there's no capital gains exemptions simply because the small business deduction was not available. So we want to make that point really, really clear. And Lorne, would you please just give us an understanding of the eligibility criteria for qualified small business corporations distinct from small business deduction eligibility?
Sure, let's conceive of an individual owner of the shares of a business corporation. There are three important tests that have to be met in order for, at the time of disposition, actual or deemed, the ability to claim the lifetime capital gains exemption. The first is looking at the value of those shares over the prior 24 months. Has the principal, that's more than 50% of the value, been derived from holding or using assets being carried on in an active business primarily in Canada? That's the first test, the 50% asset test. Second is, over that 24-month period prior to the disposition, have the shares been owned only by the person who's now disposing of the shares or persons related to that person? If there's an unrelated person who has owned it at any time in the 24 months, we're offside. And the third test is, at the time of disposition, is substantially all of the fair market value of those shares being derived from the active business being carried on principally in Canada. That's a 90% test. So we have to have all three with a typical operating company. 50% test over the prior 24 months, only related persons owning it, and the 90% test at the time of disposition. Todd, over to you.
Oh, thank you, Lorne. I think it's very, very important for everybody to take a step back at this time and think about the assets inside of your corporation. Say you have a large sum of cash, perhaps millions of dollars, or perhaps even hundreds of thousands of dollars. Do you have to be concerned about what Lorne just described? Lorne has just told you that all or substantially all of the assets of the company must be actively used in the business. And there's two cases really that we can use to differentiate active assets from non-active assets. And I'm suggesting to you that a lump sum of cash, even a relatively small amount, could cause the loss of the capital gains exemption based on Lorne's definition that all or substantially all of the assets must be actively used. So there's really two court cases, and the one that I'm thinking of is Insight versus Her Majesty the Queen. And in this particular case, the Supreme Court of Canada had rendered a decision that had the effect of differentiating between an active asset and non-active asset, insofar as the active assets must be deployed in the company to the extent that they're risked by the company. So the Supreme Court of Canada decision stated that active assets must have the character, and I'm paraphrasing, they must have the character of having a mandatory need or a mandatory precedent to trade. In other words, you can't run your company without it. So say you have a sum of money sitting in your holding company and you're depending on a capital gains exemption, and maybe a dozen capital gains exemptions, maybe 10 or $12 million worth of exemptions. Very serious, but maybe nobody's ever told you that that cash that's sitting in the company can cause the loss of that exemption. So we're trying to point out that there's some serious fundamental problems with using the kind of structures that we're hearing about by accountants and lawyers across Canada, insofar as these very critical things sometimes are not necessarily given the attention they need. And at the end of the day, if you sell your company and you don't have a capital gains exemption, well, it's going to be your problem, nobody else's. Next thing I'm going to talk about is where this rule becomes more difficult to meet. And here we have a situation with an active business where the shares are held by a holding company. And Lorne has already told you that 90% of the assets have to be actively used by the business. And here's $1 million of cash that's sitting in the holding company. So what we're going to do is at the time of sale, we'll look at the fair market value of the assets in both companies. And then we're going to decide whether or not there's 10 million. There better be 10 million of active business assets to justify the presence of 1 million. But for 24 months prior, the test changed. Maybe Lorne, you could explain what happens with this particular rule dealing with stacked companies.
Yeah, unfortunately, the government became concerned that creative professionals would move assets out of their active businesses into holding companies and still be able to sell the shares of the holding companies and claim the capital gains exemption, even though there are surplus assets in the holding companies. So they came up with very complicated, what we call anti-stacking rules, which in essence will say over the 24-month period, you have to continue to meet the 90% test throughout, not just the 50% test. So when I talked about the three things, obviously the ownership of the holding company shares has to still be in the hands of related persons. At the time of disposition, you have to meet the 90% test. But if you've got stacked corporations, you have to meet the 90% test throughout the 24 months prior as well.
So I'm going to suggest to you that parking $50,000 in a very small company overnight theoretically could cause the loss of the capital gains exemption. It's that serious. I mentioned the Supreme Court of Canada decision, Insight versus Her Majesty the Queen. I would also talk about Edward Riley versus Her Majesty the Queen in a Tax Court of Canada decision, which provides additional insight into the differentiation of active assets compared to non-active assets. And here the Tax Court of Canada had stated in this particular judgment that it really did so by way of asking a rhetorical question. That was, would the withdrawal of the assets have a decidedly destabilizing effect on the company? Again, think of the $1 million. Well, if you have it sitting in GICs, say you buy a life insurance policy inside of the holding company and say it has cash surrender value, is that okay? How many of you in attendance today have either cash, marketable securities, or perhaps a life insurance policy with cash surrender value that may be a concern? Is a life insurance policy with, say, $1 million of cash surrender value, is that an active asset, Lorne?
No, but just to put a complete perspective on this, there's another case called Insight that involved a foreign corporation that had assets that the government, in that case, I think it was the Philippines, required the cash to be made available as reserves. And so the court held in that case that you can have excess cash for your current needs, but if the outside, in this case, government requires it, then that justifies having the cash there and it being considered an act of business. In that context, it was a foreign corporation, but it's the same thing for QSBC purposes here. So the message is analyze the purpose for the cash and see whether it's actually surplus to the needs or whether it's needed for the business.
Perfect. Yeah, I think that's a good point. And when you think about what your cash flow needs are, it might be that your company is different than someone else's business. And it might be that your cash flow needs, like perhaps you have various different requirements for funding your business. But please understand, it doesn't involve expansion. If the withdrawal of the funds would have a decidedly destabilizing effect, or whether the funds are mandatory present to trade, are the questions. And CRA is armed with that. Of course, when CRA is looking at denying capital gains exemption by unsuspecting business owners that are in this situation, that's what we have to worry about. And some people will say, we're planning to buy a building. We have a purpose for the money. Well, it's not good enough. And also, perhaps you have real estate. Perhaps you have real estate units that you're renting. They're not active. If you have to be very careful. And there's various different methods we can talk to you about how we can correct this problem. And when we do, we call it corporate purification. And essentially, what we'd recommend is that any of these assets, including life insurance policies that have cash surrender value, need to be considered in the equation. So I would suggest that have a look at your bank balance later on today or tomorrow and give consideration to the question, is your bank balance and your term deposit balance and your investment account balance, do they represent more than 10% of the fair market value of your company's assets? If so, I'd suggest that you speak to us about a solution. To that end, here's a basic solution. We call it basic. I'd say that this particular strategy is, I believe, to be a very important tool in our tax planning toolbox. And what it really does is it provides the capability to be able to move those assets, whether it's real property or cash or any of the other kinds of investments or insurance policies. We can essentially separate assets from one company to another by creating an investment company. And in these contexts, we refer to this generally as a sister company. It's a sister company. Why? Because it has the same parent. And through a series of transactions, we're able to move that out of your company without any tax. In the current structure that we see, that's very common, there is no capability to pay out a dividend without paying a tax, a secondary tax. In other words, the operating company can certainly pay a dividend tax-free to the holding company, and money could sit there. But if it's going to be paying that out of the company, well, the solution may not be available. And we're suggesting that this is a concept that we could help you with in order to purify the company so that your shares are eligible. Because as I've mentioned before, one terrible misconception is, oh, don't worry about that. it happens to be millions of dollars in Holdco, my accountant and lawyer have it covered, and Holdco will sell the shares of Opco and claim the capital gains exemption, right? Wrong. Okay, so that's kind of what we're getting at here. We're trying to deal with, right now, some of the tax issues. In a few minutes, we're going to be talking about some really disconcerting facts and how your assets can be at risk. And this is more or less the background. There's been some discussion in our preliminary comments leading up to the program about the use of an estate freeze. And we're talking about the various different benefits we can have. And we talked about the fact that in family businesses, generally one of the main considerations as the older generation ages is how do you introduce new shareholders, whether it be family members or other individuals as shareholders, either directly or indirectly. And we also going to talk about multiplication of capital gains exemptions to include family members. We also are concerned about what estate freeze really is and how it's affected. Lorne, maybe you could give us a very brief synopsis on what is the anatomy of an estate freeze and how, what is the end result of an estate freeze, perhaps?
The notion of an estate freeze is to try to recognize the current value that is in the hands of the entrepreneur, freeze that value so that we know what the liability on actual or deemed disposition will be, but we try to have the future growth in the underlying business accrue to the next generation or future descendants. So if today's common shares are exchanged for fixed value shares in the hands of the entrepreneur on a tax deferred basis, we would establish a family trust that would acquire for nominal consideration new common shares. And the future growth will accrue on those common shares for the benefit of the beneficiaries of that trust, who are the family members. So as we progress through the life of the business and more value accrues on the common shares, if there's a future liquidity event, the entrepreneur will sell his or her fixed value shares for the amount that we know is with certainty we've fixed at the beginning, and the capital gain will be realized by the family trust when it sells the common shares. And it is possible, if we've been careful and qualified the common shares of the corporation as QSBC shares, we may be able to claim the lifetime capital gains exemption on that sale and multiply that exemption potentially among beneficiaries of the trust. That would be the ideal arrangement.
I'd like to just take a step back for a minute. We're now talking about trusts. And I'm going to suggest that there's probably no area which is less understood than trusts. As far as business owners are concerned, arguably accountants and often lawyers as well. And I know we have representation from all three groups in attendance today. So what I'd like to do is I'd like to ask John to give us a definition about a trust and tell us, how trusts can be used for the reasons that Lorne just described. Lorne talked about introducing family members through trusts. What are trusts? How did they begin? What are the benefits? John, please help the group to understand. Looks like John's frozen.
Sure. Well, a trust is a concept that's a trust is a concept, a law that's been around for almost 1,000 years, and it's a relationship between the settlor or the creator of the trust and the trustees. And in all cases, there are beneficiaries, and most Canadians are familiar with trusts because they're used in estate planning, and people often put assets in trust after their deaths for the benefit of children and grandchildren and so on. And we see people using trusts for asset protection purposes and for succession planning purposes. And we see them using not only Canadian trusts, but international trusts these days. And the reason why international trusts are being used is because of some case law that's been prevalent in Canada for many years, which has rendered Canadian trusts less effective than trusts in other common law jurisdictions.
So John, you're saying a trust is an arrangement. And who is an arrangement? Like, let's talk about an entrepreneur who has a family, who children are perhaps active in the business, some are not. And let's talk about a situation where an entrepreneur has a company that has substantial value. And he's concerned about how he's going to maintain control of his company, but also he's concerned about how he's going to provide for the next generation, and possibly children and grandchildren. How do you use a trust in that context, and how do you define the relationship between the entrepreneur and his other family members?
That's a classic example of the kind of planning that we are involved with every day in our various practices. Typically, in many cases, the corporate asset has become over the years the largest family asset. And so the entrepreneur himself usually takes the decision that he wants to provide not only for himself and his family during their lifetimes, but for subsequent generations. So there's a settlor, who is the person that creates the trust. There's the trustee who takes on the legal ownership of the assets. And then there's the beneficiaries, and the beneficiaries can be wives and children and grandchildren, or charities, or a combination of those, including unborn family members. And the reason why people use trusts are because
Oh, you're freezing, John. Well, John's working on his computer there. John, you're frozen. Can someone send John a note, let him know he's frozen? And meanwhile, we'll continue here. We'll talk a little bit about, here's a diagram that shows a trust, right? So if you think back, we're going to break this down into transitions so that it's more clear to everyone. And really what we've described is the capability to be able to, first of all, purify a company so that you can enjoy benefits such as the capital gains exemption. And that might come from a one-time fix, an initial purification, which involves, say, a butterfly strategy. There are other methods, but this is one that we like to use often and doesn't attract any tax. There's no taxable event in moving cash where otherwise there would be. So that's one thing that we'd start by doing. And the second thing is we set up a structure that is low maintenance or maintenance free. And that means that with the structure that you see, we can pay dividends, as you know, from an operating company up to the holding company. And it could flow through a trust back to an investment corporation, all tax-free. And by doing that, what you're doing is you're considering the case law that Lorne and I have been talking about, and considering some of the challenges that Michael is about to tell you about. And what we're saying is that to our right, we have non-active assets such as cash and other assets, investment properties. Who knows? But on the left side, we have only active assets. And by doing that, you cause eligibility for the capital gains exemption and the capability to multiply the capital gains exemption through the use of the family trusts. So essentially, Lorne described for you something that might not have completely registered the first time around. And essentially, we talked about what we're trying to do with this estate freeze. Keep in mind that there are two different types of shares that you have to understand. And the first is common shares. And if you haven't done an estate freeze, well, chances are the only shares that you're holding are common shares. By character or the attributes of the shares, they reflect the underlying value of a corporation. If the company's worth $5 million, well, then the shares are worth $5 million. If it grows to 20, so do the shares. Well, that is the nature or attributes of the common shares. And when we effect an estate freeze, we essentially have the entrepreneur, a business owner, we have you exchange your shares that you have right now that are growing in value, being the common shares, for the preferred shares, which have a stated value. And that value will never go up. It can go down if we were to have a decrease in value. We could exchange them for a lower value, but never go up, right? Having the effect of the future growth going into the family trust, as you can see here. So in other words, when the entrepreneur freezes the shares at 5 million, that means he exchanges the common for preferred shares. And then he issues new common shares that have a nominal value to a trust. And essentially, if that company was to grow from the 5 to the $10 million level, that means that they have 5 million in the preferred shares and 5 million in the trust. And again, that more or less gives you that kind of structure that can help as a platform to do a lot of different things. Now I'd like to call on Michael Miller for a moment, and we'd like to talk about limited liability. We'd like to discuss really what are the issues. And before we get started, I want to present you with a challenge as a business owner or as advisors to business owners. How safe is your structure if you have not done an estate freeze? You have shares in that you hold personally, and what if you got sued personally? And I think that I look at litigation as sort of the way some people think of illness. Oh, it happens to other people, but that isn't necessarily the case. It is not unlikely that you may be sued for a multitude of reasons, and liability insurance sometimes isn't enough. Michael, please comment to us about what would happen in the event that a family's assets were in a structure where there was no estate freeze done. There was no planning and no trusts, where the individuals holding all of the shares personally.
Okay, great. First of all, the words limited liability is a misnomer. There is no such thing as a limited liability. There is ways to limit your liability, but limited liability, we don't go around the corner, and that is based on a couple of things. On the theory of fraudulent conveyance, where we're transferring assets out of the corporation or out of your personal money, and you give that away to someone else for not current value, then that could be a fraudulent conveyance. And when that happens, a creditor, an existing creditor, has the right to reach out and go beyond what the company's done, beyond what you've done, and go after you personally and have that money recalled back to you so it can satisfy your debt to me. It also, for the last 107 years in Canada, under the Ottawa, McGuire and Ottawa Wine Vault Company case, talks about future creditors. And what we're saying here, what the case says, McGuire, is that, it's a lovely picture of Queen Elizabeth, by the way. But what we're saying here is that even your future creditors can claw back money under the theory of the Statute of Elizabeth, which is the Fraudulent Conveyances Act. And that's the biggest problem of all, because we all know who our current creditors are. Very few people know who our future creditors are going to be. We may think we know, but we may not know. Someone can come out of left field, look at what you're doing with your business, look at what you're transferring out, and have the ability to claw it back. And that is what the McGuire and Ottawa Wine Vaults Company talks about. And that was a transfer while the fellow was solvent to his wife. It was later he became insolvent, and it was challenged, that transfer. And it was challenged by someone who was not a creditor at the time. And the courts ordered that that was a future creditor and can and must be taken into account. So that becomes a major problem when you're trying to do your planning, when you don't know who your future creditors are.
I think that the disconcerting factor that we are faced with, as much as we enjoy living in Canada, and as much as there's favorable circumstances in this country that may not exist elsewhere, we do have some archaic legislation that dates back to the 1600s. And this legislation was adopted and inputted into provincial legislation that exists in every province in Canada. And in 2012, the wording became that if you're defeating a creditor, and I'm paraphrasing, and you're either hindering, delaying, or defrauding a creditor, a court can make an award that will have the effect of piercing your corporate veil. So think about those dividends you paid out. Think about the fact that you may have been lulled into a false sense of security, and the family courts are not reluctant to make claims under this legislation. And perhaps I'd ask Lorne Saltman, who has many years of experience in consulting ultra high net worth families and individuals, what kinds of effect could it have in the context of a child that marries badly? Lorne, could you help us to understand how this archaic legislation can be applied in a way to take assets out of a holding company in a way that may broadside our unsuspected attendees today?
Sure. Michael mentioned the concern about current and future creditors under the Fraudulent Conveyances Act. And let's think about the scope of who those creditors might be. They might be from business, but they also might be family members. As we know in North America, something like 50% of marriages fall apart. And so let's say the entrepreneur has a child who marries badly, and the entrepreneur has had a successful business and transferred assets from an Opco to a Holdco, maybe set up an estate freeze with an Ontario trust to own the common shares, and the spouse of the child feels wronged that all this entrepreneur has done has prejudiced him, let's say. And so he goes to family court in Ontario and tries to get an order that gives him the right to examine where all the assets are and the history, and to try to right the wrong by proving to the court that the actions were prejudicial. Now, most courts will respect validly set up trusts in Ontario or elsewhere, but there have been a few examples where family courts have broken a trust and said that the wronged divorcing spouse, let's say, is entitled to what's called an equalization payment under the Family Law Act of Ontario to bring up the value of the wronged spouse to an equivalent amount to the other spouse. And generally speaking, where that's happened is that the people in the family, let's say the grandfather, the husband, others have misconducted themselves in a way that really troubles the family law court, and so the family law court is willing to intervene. And so whenever we're setting up structures, an estate plan and so on, not only do we say to the clients, we want to put you in a jurisdiction not subject to the Fraudulent Conveyances Act. We want to set up a structure that will insulate your assets for generations against outside and inside creditors, but you've got to be aware of properly conducting yourself to minimize the exposure to claims by, let's say, unhappy sons-in-law. And I'll just briefly mention that when we do set up trusts, let's say with John McLeod in one of the jurisdictions he looks after with his trust, generally speaking, the courts of that jurisdiction, while they may have the authority to recognize an Ontario judgment, they often will respond by saying, sorry, we cannot enforce that judgment in our jurisdiction because we only have jurisdiction over assets of our jurisdiction. And our structures contemplate assets being shares of Canadian companies and not offshore shares, not offshore companies, which is a critical distinction.
Thank you.
I think if I could add to that also, the rule of Elizabeth has carried through common law in many, many jurisdictions. And basically it enforces creditors' rights. However, the Canadian jurisprudence is troubling because it contemplates existing creditors and future creditors, as was mentioned before. And whereas if we look at some of the other jurisdictions, some of the other well-known global trust jurisdictions, the tests are you have to be solvent at the time of the transfer, which most of our clients are. The transfer can't render you insolvent, so you never transfer all of your assets to the trust. The transfer cannot be a fraudulent conveyance, which it isn't at the time. And so therefore, there has to be an existing and known creditor for there to be a fraudulent conveyance outside of Canada, whereas that's not the case inside Canada.
That's excellent, John. I just want to go back and fully develop this theme, and what we're really talking about, again, is how assets inside of a corporation can become liabilities. And you've been hearing some things that I believe are very critical to your planning and your company's future growth and the preserving the assets of your family. But how many of you have considered the possibility of a massive tax assessment against your operating company having the effect of CRA going after one of your other companies to collect on tax debt? So in general, when we're talking about corporate income taxes and so on, those would be things that the shareholders would not normally, in the context of regular business income, be liable for. And the whole concept of limited liability has a manifestation in the context of things such as corporate income tax. Having said that, there's a very, very onerous position that many business owners are finding themselves running into that they didn't even know existed. And many of the accountants and lawyers we speak to across Canada are also expressing surprise. And this is a tool, a very harsh tool that CRA uses as a tax collection device that's used to thwart taxpayers who they can't collect from because they've moved money outside of the company. We've seen situations where very reputable and straightforward, honest business owners have deductions that they've declared, and CRA came in years or afterward and said, we're going to deny those deductions on that company that you ran before, and we're going to go after the dividends because company has ceased to exist now, but we're going to go after you personally. And they did. And we've defended this matter in the tax court, and successfully so in some cases. But I'm going to suggest there are so many different reasons that huge, massive assessments come out of the woodwork. We have situations where shares were not properly transferred from a deceased parent to a child. New shares were issued out of Treasury, where otherwise there was CPP and EI insurability issues where employees were recharacterized as, or rather contractors were recharacterized as employees, having the effect of huge, massive assessments where the operating company simply didn't have the capability to pay it. Well, Section 160 of the Income Tax Act, 160, and please Google this, presents a very worrisome reality for people that are setting up structures in this way, where they're like sitting ducks if this ever happened. In other words, these dividends that are being paid, thinking we're protecting them, I hope that there's never an assessment that comes your way if that's what you're doing. So there's so many different things that can be done to protect against this vulnerability. And CRA isn't always reasonable. And it's not all, that's why the Tax Court of Canada exists. And we don't like going there, but when we have to, we do. Having said that, let's protect your assets before CRA comes knocking. Let's protect your assets before one of your children marry badly. I'm sure they won't. Well, I'm not sure they won't because statistics say that they won't, but the diplomatic side of me caused me to say they won't, but maybe they will. Let's not gamble. Let's protect the assets.
Can I just add something to what you and what Lorne said a moment ago and what you just said now? I think the statistic is something like 52% of people who got married get divorced. But on top of that, there's another 20% or more that just didn't get married, but they live together and live together in a way that they're deemed to be a married couple under the family law rules. And it also doesn't apply to people who divorce more than once. So the figure is staggering. And all these people have a potential claim. If it's a common law relationship, it doesn't have to be married. It doesn't have to, has to meet the rules of common law nature, but it's not just married people.
The last
I'd like to make a suggestion as well, and that is that other than Dr. Doom here, Michael and Lorne, today is probably the best time in the last 25 years that I can think of to do an estate freeze or some financial planning. COVID, as serious as it is and so on, has had a dramatic effect on many businesses. Valuations have changed significantly. Now is a very, very important time to be having discussions about estate freezes and refreezes and thaws and all of that taxi kind of stuff that you folks talk about.
Excellent. Thank you, John. Very insightful comments from everybody, and I really feel as though there's a new awareness for many in attendance. By listening to this program, we're hopeful that we can help you to take a second look and say, what can we do to make things better and more protected? The last thing I'm going to talk about as far as assets that become liabilities, and I don't know why it's not better known, but if you've loaned a large amount of money from one company to another related company, please don't ignore that it's an asset. There's an expression in litigation that all assets are exigible, and that includes loans to related parties. And we see it so often where there's a corporation set up for the purposes of, say, purchasing a building, and money is loaned because you need a new driveway or new whatever, new roof, who knows, whatever you need for the building. Well, that asset can be attached, and that the asset is the loan can be called. And if they came to quantum business law, my theory is that Michael Miller would probably say, let's take the loan, and if we have to, we'll petition the RealCo into bankruptcy. We'll take the building. Serious business, right? All unnecessary, all too common, and there can be ways of dealing with it. So what we're going to do is talk a little bit here about a solution, because we have 8 minutes left here. And the last 8 minutes is going to be a discussion on involving all the members here about what we can do better, right? So let's kick it off by having Lorne, and then John, myself, and Michael all give a comment on the structure. Let's start off with Lorne. We have 7 minutes, so let's give everybody about a minute each, and then from there we'll open the floor to questions. Lorne first, please. What can we do with the structure?
Let's look at the left, Holdco and Opco. What we're trying to do is the estate freeze I talked about before, where the entrepreneur has frozen preferred shares, and we want common shares to be owned for the benefit of the family and the next generations. Here, our preference is a foreign trust, not an Ontario trust, because of the concerns expressed earlier about the Fraudulent Conveyances Act. And there are various jurisdictions listed there. We would customize the jurisdiction to the client's needs and choose one that gives us the superior asset protection that is available. The key is that there's a corporate trustee who has legal ownership of the assets. That would be the holding company's shares, and a new Canadian Investco, a Canadian investment corporation, set up on the far right. Legal ownership by that trustee is not for its benefit, but for the benefit of the beneficiaries of the trust, the family, the entrepreneur, and his or her family. So now we create a structure with interlocking ownership, whereby the growth in the holding company Opco arrangements the growth accrues to the foreign trust on the common shares going up vertically. Let's say those are Class A common shares. And then on the right, the foreign trust has, let's say, Class B common shares in the Invesco. And we would be able to also pay dividends from the Holdco to the Invesco through a class of shares that would be owned by the Invesco. And because the trust owns shares in Canadian companies, it's deemed to be resident in Canada under Section 94 for the specific purposes such as computing worldwide income. That foreign trust will file a T3 tax return and be compliant in Canada, and it will own and have control in the way we've just described these companies. So that's how we can move dividends tax-free up from Opco to Holdco and Holdco over to Invesco. And then the tax benefit that comes as a natural consequence of this structure is when the dividends are invested in Invesco and produce investment income, this is a private corporation that is not subject to the federal surtax because it is a corporation not controlled by Canadian residents, but controlled by a foreign trust in this case. And so the regular tax rate, instead of being over 50%, is 26.5% on ordinary income, and capital gains at half that rate, 13.25%. The key is we set up the structure as an estate plan for superior asset protection. We choose the location for the trust for that purpose. The natural consequence, however, is the tax saving on investment income. That is not the primary purpose, but it is a natural consequence of the arrangement.
Well, thank you, Lorne. I'll just maybe make a couple of sidebar comments in relation to the use of a foreign trust. Lorne mentioned various different jurisdictions: Barbados, Wyoming, Nebraska, Alaska. There's various, New Zealand. There's various different jurisdictions the trust can be established. And essentially, this whole concept is not based on sending your assets to any other country, nor is it based on taking advantage of lower tax rates in other countries either. Since this trust is deemed to be a Canadian trust under what is called the non-resident trust rules, this is not aggressive planning in any way, shape, or form. Since the tax rates that are applicable right here in Canada, we often hear of structures that makes us concerned, and we don't believe in taking advantage of lower tax rates in other jurisdictions by Canadians, because Canada's tax system is based on residency, not on citizenship. And a Canadian resident who controls or has a trust or other corporation in another country is deemed to be Canadian. We accept that, we embrace it, and we're saying that we're never going to send a red penny ever outside of Canada. The only purpose of the trust is to hold shares of companies back here in Canada. And if there were an order by a court, and then you arrived in some of these jurisdictions, the court would hear the matter, assuming it's a Commonwealth jurisdiction, and reciprocal enforcement applied, which it does between Commonwealth jurisdictions. But the court will probably hear the matter, they would hear the matter, and they'd say, well, we respect the court order from British Columbia or Ontario or Alberta, wherever it's from, but we have no assets here in this country. And therefore, the consequence would be that the enforcement of that order would be entirely unenforceable, even with having an order from the family court or some other court in hand. We would go a little further and say that when you move the assets, cash, investments, insurance to the right side, well, this provides an opportunity to do some very effective planning. The Income Tax Act provides for some very strong benefits for insurance, and insurance has an almost sacred status in the Income Tax Act. There's no tax on growth within an insurance, certain kinds of insurance. There's no tax on the death benefit. What we're suggesting here is that many very prudent business owners have been able to order their affairs in a way that allows them to be able to use products such as insurance, IPPs, RCA trusts, and other things to create benefits that wouldn't have been available in the absence of all of this architecture, of all this engineering, of all this design of the structure that provides so many things. Well, in this particular case, we have clients that have approached us and said, we'd like to be able to buy an insurance policy. We'd like to be able to have the corporation pledge it to a bank as collateral. And in turn, we will take back a loan each year from the bank. And is that a good program? Well, we've looked at it very, very closely. Of course, every plan has concerns, but insurance planning can have that effect. Shareholder benefits, personal use properties, all kinds of other things are looked at. And if it's done properly, it can yield incredible results. But doing things in silos, insurance being considered separate from accounting and separate from tax law, means that a business owner loses. We'd like to wrap this program up in the next 2 minutes. We'd like to have John make a 1 minute or less concluding comment, and also Michael. So we're going 2 minutes over our time, but please, we want to just hear some concluding comments about what this structure does, how you play the role, how we can protect our assets, and how we can pay less tax. Please.
If I can start speaking as a trustee, we've spent most of today talking about corporate assets owned by trusts, but I would like to indicate that since this is an estate planning intergenerational transfer strategy at its core, and that's what it was designed to do in the 11th and 12th century, it's important to realize that the same trust structure can be very useful in owning foreign assets. A lot of the Canadian entrepreneurs that we work with will have, a home in Florida or Arizona or somewhere, and the trust structure acts as an effective blocker against U.S. estate taxes. We also see a number of successful business people moving to Canada, and trusts can be used from an inbound planning perspective very effectively. Notwithstanding, we've talked today mostly about Canadian entrepreneurs.
John, were you one of the people in the 11th and 12th century?
Yes, I was.
Okay.
Yeah.
Absolutely. Yeah. I thought that's your history.
It takes one to know one, I guess.
I just want to say that this type of plan here looks a lot simpler than it is. To get this plan properly done, it takes a fair amount of thinking, a fair amount of work. You can't have a trust that doesn't meet all the requirements of the people who are the beneficiaries of the trust and the holders of the trust, but it is complicated. And you would not want to be involved in doing a trust that doesn't hold up somewhere down the line. So use experts if you can.
Great. Well, that brings us to a close of the program. And now we would like to take the remaining 12 minutes to, for the most interesting part, and that's to hear what those in the audience have to say. So we'd like to either open up for for audio questions or text questions. And I think we have some. Jeremy, would you like to maybe kick this question period off with presenting some of the questions that have been coming in?
Sure, Todd. Can you go to the next slide first and announce the next webinar, then we can get into Q&A?
Sure. Why don't you do the announcement, Jeremy?
The next webinar we're hosting is going to be on Wednesday, March the 10th, and it's a collaboration between Quantum Business Law and Sheldon Group, a firm that specializes in tax incentives and SR&ED, scientific research and experimental development. So for any companies or advisors with clients involved in R&D, possibly manufacturing or software, we invite you to take advantage of this next session. You'll be receiving an email invitation, and look forward to everyone joining us at the next session on March 10th.
Thank you. All right, let's get into some questions. We love questions from participants. Do you want to maybe present the questions to our expert panel, Jeremy? Not sure. Okay, so I'll open these up and I'll present the questions then. So we have a question here. If we qualified to own corporate shares, should we register the business as a corporation or a limited partnership? Well, the question might have been mistyped. Clearly, let me just, okay, so it looks like there's a question here that we'll skip that one because I think there was an error in the typing. Okay, would a large scale potential put you offside for the 24-month 50% QSBC condition? For example, a builder sells a property for $1 million. This sale would result in active business asset of inventory being charged to a non-active business asset. Okay, so I think what the question is here, there's a question from one of our attendees, would this 24-month rule apply? And the answer, I'm going to let Lorne handle this first question.
It is pretty obvious. The answer is yes. If what you've done is convert an active asset into just cash, and what we talked about earlier, if the cash is not necessary for the stability of the business, it's surplus, that will taint the structure, and you'll have to do a purification and wait 24 months.
Great. Okay, here's one I'll answer if you don't mind, my colleagues, right? What about if there's a deemed foreign trust as a Canadian trust and the freeze is done in Canada? Well, Section 94 of the income tax deals with what's called the NERT rules, non-resident trust rules. And these rules that we call deeming rules deem the trust that we use to be a Canadian trust. That's our starting point. We're not trying to overcome a bar or a hurdle that is difficult, because that is what defeats many of the bad plans, is the fact that the trust is deemed to be a Canadian trust. Well, in our structure, even though a trust may be located outside of Canada, providing that the individuals, the entrepreneurs, the family are here in Canada, well, the trust will be deemed to be a Canadian trust for purposes of computing worldwide income. In fact, the trust will file a T3 tax return.
But let me just add to that, Todd.
Please.
Yet it still is a foreign trust. So if John, with one of his trust companies, let's say in Barbados or New Zealand, is the legal owner, the Income Tax Act doesn't change the status of that trust as being foreign. And therefore, we look at who has de jure control or voting common shares of the Canadian Investment Corporation. It is a foreign trust for that purpose. And that's what gives us the right to say it's a non-CCPC, and we pay less tax on investment income than would be the case otherwise.
Yeah, and I would quote, Canada Trust Co. versus Her Majesty the Queen in a 3-part test. And one of the questions that would be considered, and you realize there's a tax benefit that is a natural consequence of achieving asset protection is not available in Canada. This legislation, which is archaic and sometimes punitive and onerous upon business owners, does not exist in other countries. And essentially, we have good reasons for doing our work. We have purposes such as multi-generational or intergenerational transfer of wealth, as well as achieving asset protection. And I mentioned previously that Canada has become a creditor-friendly country, and that the banks and large institutions have been able to petition, to lobby to effect changes. And one of the things that we are concerned with is that if an individual is holding significant assets in Canada, it may not be safe. Going to another country that doesn't have that doesn't mean your money going there, doesn't mean any risk of losing your assets, putting it in harm's way, because it all stays here. So when Lorne's talking about this investment company, the director is the entrepreneur, the business owner. The only signatory in the bank account who can sign checks on behalf of the company is the entrepreneur. The trust is a holding instrument only, which has de jure control over the shares of the company in a fashion that segregates two concepts. One is the definition of a Canadian trust under Section 94 of the Income Tax Act. The other is the common law principle of management and control. And what we're suggesting is that a trust company such as Eticas International would act as the corporate trustee, but in a way that the trustee is entirely prohibited from enjoying even one iota of benefit from the trust or the underlying company, other than the fee that the entrepreneur agrees to pay to the trustee rather. So really what we're doing is we're creating a model that allows us to be able to confidently achieve a number of objectives. It's all based on you, the business owners, you, the accountants and lawyers, your clients' likes and dislikes. We come up with a plan that embodies these purposes. Because one of the things that we're worried about with GAR always is there a bona fide purpose? Sure, there's a tax savings. You go from paying 50.13% on investments, on passive income. You pay 25% on capital gain. Well, those numbers are much less because of the fact that you have a trade-off. It's not a misuse or abuse of legislation. And so far as there's a trade-off, and if you have a Canadian company that it needs a small business deduction, needs a capital gains exemption, well, that's great, but you lose that if you have a foreign controlled company. And if you have a real strong purpose, and we could talk all day about the purposes of the planning we're doing, which have nothing to do with tax savings. Tax savings happens to be the result that is achieved by creating the mind and management, the control of this company in a foreign jurisdiction without offending the NERT rules. And someone's asking, what jurisdiction would you recommend to have the Treasury bank account? Well, that's going to be right here in Canada. The Treasury bank account, for the gentleman that's asking, is going to be located at your local branch of the whatever bank that you're most comfortable with. And in Barbados, as an example, one of the jurisdictions is Barbados. And of course, we know that Eticas is located in various countries around the world, but Barbados is a viable country to use in a number of ways because it has a well-established judicial system. It's well over 300 years old. It essentially does not have onerous legislation which anticipates future creditors, giving the result that an individual can come in and actually take that. We have another question that just popped up, and Lorne or John, I'll have you answer this one. Maybe Michael, you can take your pick. We have a question here from Gord out of Western Canada, and he's asking about liability of a divorced person and how that might be protected. John, you have a lot of experience in acting as a trustee where there's been claims and lawsuits and so on. And I think what is being asked is if an individual has a separation agreement reopened, as an example, and assets happen to be in a trust, well, what could happen? What would the effect be? I believe that's what our friend from Western Canada is asking.
Well, I can make a stab at it. It'll be very fact-based, but if, as a matter of fact, I'm dealing with something very similar to that right now, where we've set up a trust in happenstantially Barbados, but it could have been anywhere. And the client is about to go through a divorce, and the trust was set up a number of years ago. The statute of limitations of 3 years has gone by already, so the assets are fairly well protected. And in this case, there was no possibility of there being a fraudulent conveyance, and the trust property is not the proceeds of crime. So my feeling and the feeling of legal counsel in Canada is that these assets are protected for the benefit of the beneficiaries, which include children and grandchildren and so on, but also interestingly include the spouse. But the spouse does not have any fixed entitlement. The spouse could receive, at the discretion of the trustee, since it's a discretionary trust, a distribution.
Thank you, John. Now, this question here, how is it possible that cash can be considered a non-active asset? Isn't so? Okay, so the law says that all go ahead.
Excuse me, sorry. I just want to add, John just mentioned the 3-year limitation period. That's got nothing to do with the trust. That's got to do with the actual where the trust is being held. I believe he was talking about Barbados, because Barbados has a 3-year limitation period, which is
right.
Quite generous to creditors, but it is not. It's usually more. In Canada, it would be 6 years, that sort of thing. So it depends where the trust is set up, what the limitation period would be.
Oh, thank you very much. There's another, thank you. There's another question here. How is it possible that cash can be considered a non-active asset, which obviously is concerning, right? So let's look at it this way. Is the cash a mandatory precedent to trade? If you have $1 million sitting in a company, is the company dependent on that to sell its goods and services? The answer is no, it's a bad asset. You shouldn't have more than 10% of your assets if you want to do things according to the letter of the law in cash or any other form. Some cash is needed for operating capital, but excessive cash is not. Question is it beyond what's necessary to provide your services? CRA will not hesitate to disallow a capital gains exemption because of an excess amount of surplus cash. And the other question is, would the withdrawal of the cash from the company have a decidedly destabilizing effect? So therefore, we caution you. We know it's not very well known. The problem is it's very well known by the CRA. So we're trying to help you to fix it before they come and point it out. It's better you hear from us than not hear from anyone other than the CRA. Another question is, how do you get a lower rate of tax rate on investment income, say the 26%? Lorne, would you maybe clarify that, please, for this individual?
How do we get the lower rate? The structure that we've been talking about has a foreign trust that has legal control over a Canadian private investment company. It is not a private investment company owned by a Canadian resident. Investment income earned in that case, a CCPC, is taxed in Ontario at 50.2%. In our structure, the private Canadian corporation being owned by a trust in a foreign jurisdiction is a non-CCPC. And so usually you have the regular federal corporate tax of 26.5% and a federal surtax in a private corporation on top of that another 24 percentage points to bring it up to just over 50% as part of the system of integration of investment income in Canada, where an individual is taxed the same whether investment income is earned personally or through a corporation. But the mechanism, without going into all the detail, the mechanism for a CCPC requires there to be the federal surtax, but not when the corporation in our structure is owned and controlled by a foreign trust. We do not have to pay that federal surtax. We only pay tax at the lower rate, 26.5% on ordinary income and 13.25% on capital gains.
I think we'll take one more question. So many amazing questions, but there's another one. And thank you, everyone, for these questions. We could do this all day, but out of respect for your time, we're going to make this the last question. I saw this as a general question about a structure that it may not work, won't work for professional corporations because their family members may not be able to be shareholders and so on. Well, we have a different structure for purification of professional corporations. And yes, we acknowledge the difference. And it depends upon the professional, the body that governs these professional these professional corporations. But there are other structures. We wish we could take more time. Thank you for that. Thank you for other clarifications. We noticed that some of you have sent in some comments about business values. I noticed a business valuator stated, well, it's true of some companies, but not all. And that's true. There are some companies that are doing really well in light of COVID-19. And we're not implying for 1 minute that all companies are at a diminished value. But nonetheless, we really appreciate everyone's participation and attendance. We look forward to the next program. And I believe it was March the 10th, Jeremy, is that right?
That's right.
Okay, thank you ever so much. And we look forward to reconvening for the next session very soon. And please call us if we can help you. Any of you accountants and lawyers, we have a tax assist program that you probably know about. And we don't render you an invoice for talking to you about these kinds of issues normally. We can do some consulting that can help accountants and lawyers provide effective tax advice to clients without the need for you to encumber yourself with large legal bills. So we're happy to help in any way we can. Thank you.
Bye.
Bye-bye.